Welcome, curious minds, to the deep dive. Ever poured everything into something, totally convinced you were right, only for it to just blow up
Yeah.
because of something you just didn't see coming?
hmm Or the opposite, right? You see someone just kind of stumbling along, making mistakes left and right,
Hmm.
and somehow they hit it big, massive success.
Exactly. It really makes you stop and think,
hmm
what does being right even mean when it comes down to it? Today, well, we're diving deep, really deep, into some fascinating material you sent over, excerpts from Nassim Taleb's big book, Antifragile.
That's right. And our mission here really is to unpack the core thinking in these sources. We want to pull out those, nuggets of wisdom that really push back against how we usually think about success or failure or even just integrity, in the real world.
Yeah, what does it actually mean to have skin in the game, that personal stake?
Exactly. And how does that idea shape everything from like the small choices you make every day to the huge decisions made by giant corporations, maybe even governments?
Okay, so get ready because some of this might shake things up a bit. We're going to look at why being wrong, maybe even wrong often, can actually lead to huge success, which sounds crazy, I know.
Right. And why Mother Nature, the ultimate decider, just doesn't give a toss about our well-reasoned opinions.
And maybe, just maybe, why the economic system we live in. Well, why it might not be set up in your favor, despite what you hear. Okay, let's really get into this.
Let's do it.
So first up, this thing Taleb calls the payoff paradox. This idea that, being correct isn't really the main thing. It starts with this difference he draws between, what is it, Thalesian and Aristotelian ways of looking at things.
Yeah, exactly. Thalian and Aristotelian. And this distinction is pretty fundamental to his whole argument. Think of it like this.
Uh-huh.
The Aristotelian view, that's all about words. Forecasts, opinions, debates, sounding smart, winning the argument.
Like academic debates, or maybe political punditry.
Precisely. It's the world of ideas, of logic on paper. But the Thalesian view, that's completely different. It's focused on deeds,
Mm.
actions, payoffs, what actually happens in the real world because of what you did, the consequences. And Taleb's big point, the kind of revolutionary bit, is that out here in the messy real world where we actually live and make choices, only the Salesian view counts. What happens, not what was said.
Wow. Okay, that's a huge shift right there. So it's not about having the best theory or the most convincing PowerPoint. It's about, did it work? Did you get the result?
That's it in a nutshell. And this leads straight to that really counterintuitive idea, how often someone is right. Well, it's kind of irrelevant.
Which just blows up how we usually judge people, right? Like in school or even at work, getting the answers right is everything.
Right. But Taleb says that's misleading, because what really matters are the consequences when you are right or wrong. And crucially, the asymmetry of those consequences. Is the potential gain massive compared to the potential loss or vice versa?
Okay, asymmetry. Explain that a bit more.
Well, he uses this analogy. You need to be a practitioner, someone who does things, not just a talker. Think about it. Maybe you predict things correctly 80% of the time. Looks great on paper, right? Gets you praise, maybe a promotion.
Sure, feels pretty good.
But what if that other 20% includes one single mistake that's so catastrophic it wipes out all your previous wins and then some? Suddenly that 80% success rate means nothing. It's the payoff structure that defines success, not just how often you guess right.
Got it. So it's not the batting average, it's the runs scored, or maybe avoiding that one massive strikeout that ends the game.
You hit the nail on the head. And that brings us right to his concepts of fragile versus anti-fragile payoffs. This is where it gets really practical.
Okay, fragile versus anti-fragile. Let's break those down. What's a fragile payoff?
A fragile payoff is basically a situation where your potential upside is small, maybe even capped, but your potential downside is huge, massive, possibly infinite, or at least ruinous. Taleb calls it making pennies to lose dollars.
Okay, pennies to lose dollars. Like picking up coins in front of a steamroller.
Kind of, yeah. You might get small, steady gains for a while, but you're incredibly vulnerable. One big shock, one black swan event can destroy everything. Now, an anti-fragile payoff is the exact opposite.
So lots of upside, little downside.
Exactly. Very little downside, maybe losing small amounts frequently, but the potential upside is significant, maybe even unlimited. This is where you might lose pennies often, but when you win, you make dollars. Big dollars. It's a structure that actually likes volatility and randomness.
This is where it gets really interesting because it implies someone could be wrong like most of the time.
Yeah, lose off
And
there.
still come out way ahead, while someone else who's maybe technically right more often could get totally wiped out.
That's precisely the power of anti-fragility in action. If you set yourself up with an anti-fragile position, you can afford to lose small amounts, experiment, be wrong repeatedly, often with impunity, as Taleb says, because the losses don't kill you.
They're just learning experiences, or the cost of playing the game.
Exactly. But you only need to be right once, hit that one big win with massive positive consequences, and it can dwarf all the previous small losses. But for the person in the fragile position, one big loss can be game over, bankruptcy, career finished, done.
Can you give a real-world example of this? The source mentions the 2008 financial crisis, right?
Oh, absolutely. That's a classic case study. Imagine you were someone back in, say, 2005 or 2006 who looked at the big banks and thought, this looks incredibly fragile, too much hidden risk. Maybe you started betting against them, perhaps buying credit default swaps or shorting their stock.
Which would have cost you money for a while, right? The market was still going up.
It would have. It would have cost you pennies over years, as the source puts it. You'd be losing a bit consistently.
Yeah.
People, journalists, market experts, they probably would have called you wrong, maybe even crazy, for years.
Look at this idiot betting against the housing market.
Right. Your predictions would seem off. But then, 2008 hits. The whole thing collapses. And suddenly, your anti-fragile position pays off massively, immensely. Your gains would have been astronomical, far outweighing all those small losses.
Okay. And what about someone who just, wrote an article predicting the crash but didn't bet on it?
Well, they might get some "I told you so" points later, maybe, but they didn't benefit from the Thalesian payoff. And worse, someone who predicted the event but was themselves invested in a fragile way could still have lost everything. Being right in words, Aristotelian, is totally different from being positioned correctly for the payoff. Thalesian.
So it's not who called it, it's who cashed the check. Or maybe who survived the storm. That is a stark difference.
It really is.
And you see this play out with entrepreneurs all the time, don't you? They seem to embody this.
Perfectly. Entrepreneurs are almost the definition of this anti-fragile approach. They're usually wrong, Taleb says. They make mistakes, plenty of mistakes. Think about how many startups fail, how many products flop.
The vast majority, statistically.
Exactly. But they are convex. That's his term for having that anti-fragile payoff structure. What matters isn't the string of small failures. What counts is the magnitude of the occasional success. One huge hit can make up for dozens of misses. Their overall success isn't about being right often. It's about structuring things so that the wins, when they happen, are massive.
So it really does boil down to deeds over forecasts. What you do in the real world is Thalesian. What you say or predict is just Aristotelian chatter.
Pretty much. And we use this Thalesian thinking in everyday life more than we realize, often without labeling it.
Like how? Give us some simple examples.
Okay, the source gives a couple of good ones, like imagine you're hiking and come across a stream. You don't know the water is poisonous. You might even think it's probably fine. But we don't believe the water is poisonous, but we avoid drinking it,
Right.
just in case.
Yeah, you err on the side of caution because the downside of being wrong is potentially huge.
Exactly. Or airport security. We check people for weapons, even though the statistical probability of any random person being a terrorist is tiny. We don't act based on being right about the probability. We act to prevent the catastrophic downside. The consequence of missing one real threat is unacceptable.
So you optimize for avoiding disaster, not for being statistically accurate in your prediction every single time.
Precisely. It's a survival heuristic.
And this leads to Taleb's rather blunt sucker test. He doesn't mince words here, does he?
No. Taleb is famously direct. He puts it starkly. Suckers try to be right, non-suckers try to make the buck.
Ouch.
Yeah. And he adds, suckers try to win arguments, non-suckers try to win. It forces you to really look at your own motives. Are you debating just to prove you're smart, or are you focused on achieving the best outcome?
Even if it means losing the argument sometimes.
Even then, the source actually says it is rather a good thing to lose arguments if losing that argument somehow leads you to make the right decision for the wrong reason, meaning a decision with a good Thalesian payoff, even if your Aristotelian logic wasn't perfect or convincing at the time. It challenges intellectual pride head-on.
Wow. That's a lot to chew on. Especially for anyone who prides themselves on being logical or well-informed. And it connects right into the next big theme, Mother Nature's indifference. If we shouldn't care that much about being right in arguments, nature cares even less.
Infinitely less. Yeah, for Mother Nature, as the source says, opinions and predictions don't count. Surviving is what matters. Full stop. This just reinforces the Thalian view, but on an evolutionary timescale.
So nature doesn't care about your theory, just whether you or your species sticks around.
Exactly. The biological world doesn't run on peer reviews or performance evaluations. It runs on survival and reproduction. And Taleb uses this as perhaps an underestimated argument for free enterprise, for societies driven by individual doers or adventurers, as Adam Smith apparently called them.
As opposed to central planners.
Right, as opposed to central planners and bureaucratic apparatuses, because the doers, the entrepreneurs, they have skin in the game. They learn directly from real-world consequences. Planners, often they don't.
So what makes bureaucrats or big organizations fragile in this naturalistic view? Why are they kind of unnatural?
Well, they tend to operate in a system that rewards narrative, an opinion of others with job evaluation and peer reviews. It's about looking good, sounding convincing, managing perceptions, what Taleb calls marketing history.
So success is based on reports and presentations, not necessarily real-world results.
Often, yeah. It encourages playing it safe, avoiding blame, and getting those brownie points for predictions, even if reality doesn't cooperate. Evolution, on the other hand, hates that confirmation fallacy that I told you so stuff. Nature selects for what works, not for who sounded like they knew what would work. Bureaucracy often stifles that messy trial-and-error process that leads to antifragility.
Okay, so intellectual correctness is just a human game. Survival is the real deal. Now, this leads to an interesting critique of Karl Popper. We usually think of him as a giant, right? Falsifiability, all that.
Absolutely. Popper was huge, and he had this idea of evolutionary epistemology, basically, that ideas compete like species, and the best, or at least wrong, ideas survive.
Sounds reasonable. Where does Taleb disagree?
Taleb argues Popper kind of missed the point. He says it's not just the ideas that survive, it's the people who hold the right ideas, or the societies that adopt the correct heuristics, the practical rules of thumb. It brings it back to the Thalian, the practitioner, the person or group whose actions lead to survival, not just the abstract idea itself.
So it's the application, the behavior that matters for survival, not just the theory.
Exactly. And he goes further. He points out that sometimes wrong ideas can survive just fine as long as they're harmless. And maybe more importantly, behavior that looks irrational can actually be really good for survival.
Okay, hold on. Irrational behavior being good. How does that work? Give us that bear example from the source.
Right, this is a great one. Imagine you're an ancestor out on the savannah. The source asks, which is more dangerous, to mistake a bear for a stone or a stone for a bear?
Mistaking a stone for a bear means you jump and run unnecessarily? Wasted energy? Mistaking a bear for a stone?
Yeah.
Well, that sounds fatal.
Precisely. Those who constantly overreact upon seeing what may look like a bear, mistaking stones for bears, they make a lot of false positive errors. They seem jumpy, maybe irrational, but they survive.
Because the cost of that error is small.
Minimal. But the folks who made the opposite mistake, mistaking a real bear for a harmless stone, well, as Taleb bluntly puts it, they left the gene pool. They didn't pass on their rational tendency to underreact.
So being irrationally cautious is actually deeply rational from a survival perspective because it minimizes the catastrophic downside.
Exactly. It's an evolved anti-fragile strategy. Play it safe when the potential cost of being wrong is extinction, even if it makes you look wrong most of the time.
Fascinating. And this whole section really hammers home the mission you mentioned, to make talk less cheap, which is the perfect segue into the next big topic, the absolute necessity of skin in the game and even soul in the game.
Indeed. And it's not a new idea. The ancients, the source argues, really understood this, maybe better than we do today. They intuitively got the agency problem.
The agency problem, that's when someone acting on your behalf, like an agent, has different incentives than you, the principal, right?
Exactly. Like a manager running a company for shareholders or a builder constructing a house for a homeowner. Their interests might not align, especially if the agent isn't exposed to the negative consequences of their actions. The ancients came up with some pretty direct ways to deal with this.
And the Romans seem like prime examples. That bridge story is pretty vivid.
Oh, it's unforgettable, isn't it? The tradition, or maybe rule, of forcing engineers to spend time under the bridge they built after it was finished.
Talk about accountability.
It's the ultimate skin in the game if your bridge collapses. You go down with it. No hiding, no blaming someone else, no complex legal battles. Just immediate, personal, fatal consequences for failure. It focuses the mind wonderfully, I imagine.
I bet. And they had other methods too, right, in the military, the sacramentum and decimation. That sounds grim.
It was incredibly grim, but apparently effective. The sacramentum was basically this oath soldiers took, not just loyalty, but accepting punishment for failure, owning the downside. But decimation, that was extreme.
What exactly was it?
If a whole legion, thousands of soldiers, performed poorly in battle, maybe showed cowardice, the commanders would select 1 out of every 10 soldiers by lottery, and those selected would be executed, often by their own comrades.
1 in 10, randomly.
Randomly, including commanders sometimes. The idea was that this specific ratio, 1 in 10, was enough to make everyone terrified of collective failure, removing the incentive for any individual to shirk their duty or act cowardly because anyone could pay the price. It forced collective responsibility and made the whole unit more anti-fragile, albeit brutally.
Wow. That is intense. It completely changes the calculation for every single soldier. And this idea of removing the escape route, burning the bridges, seems like a recurring theme too.
It is. A really powerful, timeless strategy. The source gives the example of the Arab commander Tariq in 711 AD. He sails his army across to Spain, lands, and then
Where's the ship?
burns the ships, gone, then tells his troops basically, the sea is behind you, the enemy is in front, you've only got your swords and your courage. No retreat possible.
Talk about forcing commitment.
Total commitment.
Yeah.
It makes the army anti-fragile because the only option is to succeed or perish. And it's not unique to him. Cortez did something similar in Mexico centuries later. Agathocles of Syracuse did it even earlier fighting in Africa. It's this ancient heuristic. Eliminate the fallback, force maximum effort, embrace the anti-fragility that comes from having no other choice.
Incredible. The psychology of that must be overwhelming.
Yeah.
And it doesn't just apply to armies, right? The story of the poet Al-Mutanabi. His words literally killed him.
It's an amazing, tragic story. Al-Mutanabi, ancient Arabic poet, maybe the greatest ever in the eyes of some experts. Huge talent, but also apparently a colossal ego. His name basically meant he who claims to be a prophet.
Okay, so not lacking in confidence.
Not at all. And in his poems, he boasted constantly about his bravery, his skill, how even lions respected his courage. He wasn't just writing verse. He was defining himself.
Setting a very high bar for himself.
Extremely high. So the story goes, he'd insulted some powerful desert tribe in a poem, and they ambushed him. He was vastly outnumbered, certain death awaited. His first instinct, run, totally rational.
Makes sense.
But then his companion, maybe trying to shame him or inspire him, starts reciting Al-Mutanabi's own poem back to him. He knew the horse, the night, the desert. Imagine hearing your own boasts thrown in your face as you're about to flee.
Oh, wow, the shame.
Exactly. He couldn't live with the dishonor, the contradiction between his words and his actions. So he turned back, faced the tribe, and died. He died for his poetry, to make it genuine. His words weren't cheap talk, they cost him his life. That's profound soul in the game.
Chilling. And a stark contrast to what Taleb calls the modern problem of insulation, where people, especially talkers, are totally disconnected from the consequences.
Completely disconnected. The source mentions David Hume, the famous skeptic philosopher. Apparently, he'd leave all his deep philosophical doubts about reality in his study, his philosophical cabinet, and then go out and enjoy life like anyone else.
So, skepticism for thee, but not for me.
Kinda, yeah. The problem of insulation applies when someone is skeptical or holds certain beliefs in one context, like academia, but doesn't apply them in their own life. The philosopher doubting time, but applying for next year's grant money is a classic example. Fine for pure philosophy, maybe, but a huge issue when the ideas are meant to apply to the real world.
Which leads to the simple test. Eat your own cooking. If your ideas are practical, do you use them? And Harry Markowitz, the Nobel Prize winner in economics, is the poster child for not doing this.
He really is. Markowitz won the Nobel for his complex portfolio selection theory, how to optimally allocate investments. Brilliant stuff mathematically. But his own retirement portfolio, he admitted he didn't use his own complex methods. He used a simple 50-50 split between stocks and bonds, cab driver methodologies, as he apparently called it.
Huh. That's quite an admission.
It perfectly illustrates Taleb's heuristic. Does the scientific researcher whose ideas are applicable to the real world apply his ideas in his own daily life? If so, take him seriously, otherwise ignore him. Unless it's purely abstract stuff like math, of course.
Makes total sense.
Yes.
But then there are even more glaring examples like that happiness researcher.
Oh, that one's almost comical if it weren't so blatant. This researcher publishes influential papers saying happiness doesn't really increase beyond an income of, say, $50,000 a year. Okay, interesting finding.
Yeah.
But then it comes out that he himself is earning way more than that, like double, and is particularly avid of dollars, constantly traveling and giving paid talks to earn even more money.
Seriously.
Seriously. For Taleb, that personal behavior, that disconnect, is more telling than any academic citation. It
Mhm.
shows his talk is cheap because his actions scream the opposite. Zero skin in the game regarding his own research findings.
Wow. And this insulation stretches into politics too, right? Champagne socialists.
Absolutely. Another blatant case, as the source puts it, people who passionately advocate for socialist policies, maybe wealth redistribution, high taxes, while living incredibly luxurious lives themselves, often funded by inheritance. They want others to live a certain way but exempt themselves.
So they preach austerity or equality from their mansions.
Pretty much. The source contrasts someone like General de Gaulle in France, known for his personal austerity, with François Mitterrand, a socialist president who apparently lived like royalty. The gap between the talk and the walk is huge.
It's definitely something people notice. And that story about the wealthy client wanting higher taxes while dodging his own. Perfect summary.
It really is. This client pushes the author to donate to a politician campaigning on higher taxes for the rich. Seems noble, right? Supporting something against his own financial interests.
Yeah, looks like skin in the game initially.
But then, surprise, turns out the client himself is under investigation for a massive tax evasion scheme. It just perfectly captures that hypocrisy, that total insulation from the principles they publicly endorse.
Okay, so lots of examples of people without skin in the game. But the source contrasts this with Ralph Nader. He's presented as the opposite, like a secular saint.
Yeah, Nader is held up as someone with absolute no divorce between what he preaches and his lifestyle. He lives incredibly frugally, embodying the consumer advocacy and anti-corporate principles he fights for. He endures smear campaigns with courage, totally committed. He doesn't just talk. His entire life is the message. That's soul in the game.
So soul in the game is deeper than just having money on the line. It's like a core commitment.
Exactly. It's described as a doxic commitment, a belief so deep it becomes part of who you are, and it must translate into action, often costly action. Taleb argues the true originator of an idea isn't the first person who idly mentions it, but the person who believes it so strongly they commit to it fully, risk everything for it, take it to its conclusion.
Someone who lives it, breathes it, and accepts the consequences.
Yes. And crucially, only he who has true beliefs will avoid eventually contradicting himself. That costly commitment ensures consistency. It's revealed through action over time.
A powerful idea of authenticity, which brings us maybe inevitably to the really uncomfortable part, how this lack of skin and soul in the game plays out in modern corporations and their marketing.
Yeah.
The stock market itself gets a harsh critique here.
A very harsh critique. Taleb sees the modern stock market not just as investment, but as this giant machine for transferring anti-fragility, basically, transferring risk away from managers and onto savers and the public. It's a vicious form of asymmetric skill in the game.
Because of the agency problem again. Managers playing with other people's money.
Precisely. It's the blatant manifestation of it. Managers get huge incentives, stock options, bonuses for upside performance. But the downside? It's limited for them personally, but potentially catastrophic for the shareholders, the retirees, the taxpayers. They get free options, Taleb says, benefiting from volatility while others bear the cost.
And the cost is significant.
Staggering, according to the figures in the source. Over a dozen years, the U.S. stock market cost retirees something like trillions compared to safer investments, while the managers of those same companies got richer by hundreds of billions thanks to those asymmetric options. Taleb's phrase is blunt. They pull the tails on these poor savers.
That's a huge transfer of wealth, and it's even worse in banking.
Especially in banking. Banks lose monumental sums, more than ever made in history during crises, yet the managers walk away with billions. The equation is simple and infuriating. Taxpayers take downside, bankers get the upside.
Which Taleb calls a form of socialism for the rich.
Exactly. Government bails out the losses, socialism, while the bankers keep the private gains, crony capitalism. And the kicker, volatility, which hurts savers, actually helps managers with options. Their options gain value from big swings, even if the overall trend is down for investors. The more jagged the route, the better it is for them.
So their incentives are actually opposed to the long-term stability that benefits most people.
Directly opposed. And Taleb is unambiguous. If you don't see this transfer of anti-fragility as theft, you certainly have a problem. He points to Robert Rubin getting $120 million from Citibank before its taxpayer bailout, a common pattern, he argues.
What about things like clawbacks? Making them pay bonuses back if things go wrong later. Does that fix it?
Not really, according to the source. Clawbacks might recover some money, but they don't fundamentally change the asymmetry. The manager's own net worth is rarely truly endangered to the full extent of the potential losses. They still have net upside and no net downside overall. Their personal wealth is largely insulated, unlike, say, the owner of a small business. This applies to pension fund managers, too.
It's a stark contrast to how things used to be, isn't it? You mentioned beheaded bankers.
Yeah, the source brings up historical examples. The Code of Hammurabi had harsh penalties, that medieval Catalonian tradition of executing failed bankers. Even the mafia, pragmatically, deals harshly with those who lose its money. Some countries today, like Brazil apparently, make bankers personally liable with their own assets. It's very different from the modern Anglo-Saxon model of insulated management.
And Adam Smith, the supposed father of free markets, he actually worried about this very thing.
He did. People often misquote Smith to defend large corporations, but Taleb points out Smith was extremely cautious of giving someone upside without downside. He doubted the whole idea of limited liability joint stock companies precisely because he knew managers handling other people's money wouldn't watch over it as carefully as if it were their own. He was wary of the agency problem from the start. The modern corporation isn't quite what Smith had in mind.
This suggests a deeper issue with corporations themselves, that they're inherently kind of ethically challenged,
Yeah.
like soulless machines.
That's the argument. Why do giant corporations push sugary drinks and processed junk, while small artisans often sell healthier natural products? Taleb sees it as this transfer of anti-fragility again. Big companies need constant growth.
They have to feed the beast for the stock market analysts.
Right. They work by addition via positive, not subtraction via negative. A drug company doesn't profit if you stay healthy by avoiding sugar. A gym equipment maker doesn't profit from you hiking outdoors. A broker doesn't profit from you making fewer trades. They have to generate revenue growth, often by creating artificial needs or selling things with hidden downsides.
Like the sugary water empire.
Exactly. Companies selling sugary drinks, messing with our biology, contributing to diabetes, which then benefits the companies selling diabetes drugs. It's a cycle. They can't make money selling tap water, so they market addictive, unhealthy alternatives relentlessly. Why aren't the arguments against tobacco applied more broadly, the source asks.
And that PepsiCo debate story illustrates the constraints perfectly, right? The executive trapped by the corporate line.
It's a fantastic illustration. The PepsiCo chair arrives super prepared with a huge staff, sticking to the script. Taleb and his partner are unprepared, spontaneous. But they have freedom. They can say anything without personal consequence. She can't. One wrong word could tank the stock, hurt her bonus.
She has negative skin in the game in a way.
Yeah.
Fear of loss.
Precisely. The source even questions if truly intelligent, free-thinking people can even function long-term in such roles, needing to constantly self-censor and follow the party line. It also highlights the argument that large corporations use their size, like employing 600,000 people, to gain political influence, allowing them to wreck the health of citizens with impunity and get bailouts, unlike small businesses.
So the rule of thumb seems to be small, local, artisanal, probably healthier, more naturally needed, large, heavily marketed corporate, likely selling wholesale ironies and using lobbying to protect themselves.
That's the gist of it. Anything requiring massive, pervasive marketing probably has hidden downsides or isn't truly necessary, which leads to the idea that marketing itself is a signal of inferiority.
A bold claim in our ad-saturated world.
Very bold. But the argument is truly great things, exceptional food, wine, books, art, restaurants, spread by word of mouth. That's the potent naturalistic filter. Corporations excel at making the cheapest thing that meets specs, not the best thing. Think rubbery supermarket cheese versus artisanal cheese.
And the comparison to personal boasting?
Yeah.
It's spot on. We dislike it in people, why not in companies?
It's a great question. If someone corners you and brags endlessly, you're repulsed. Why do we accept corporations spending billions to do the same? Taleb sees 3 levels of violation here.
Okay, what are they?
1, mild self-promotion. Bad manners, mostly harms them. 2, hiding defects while promoting positives. More serious, we rely on reviews and skepticism. 3, the worst, misrepresenting the product by hijacking our psychology. Like using positive imagery, cowboys, sunsets to sell harmful products, cigarettes. That's exploitative.
And the root cause is the corporation having no soul.
That's the core argument. A corporation does not have natural ethics, it just obeys the balance sheet. It exists to hit metrics for analysts. It feels no shame, no pity, no honor. It can't be truly generous. Any generosity is PR.
It's just a machine optimizing for profit.
Exactly. And Taleb argues such systems should fail due to their inherent flaws. But the managers don't care because of the agency problem. Their personal cash flow is insulated. So they use lobbyists to hijack the state and delay the inevitable corporate funeral, all at the public's expense.
A pretty damning indictment of modern corporate structures.
Ugh.
But the final section offers a contrast, right? Focusing on honor and trust and how individuals can possess them even if institutions struggle.
It does offer that crucial distinction. It starts with T. Lawrence of Arabia. He made promises to Arab tribes during WWI, help us fight the Ottomans, and you'll get independence. They fought, they had skin in the game.
But the British and French had other plans.
Secretly, yes. The Sykes-Picot Agreement carved up the Middle East for themselves, betraying the Arabs. Lawrence was devastated. His lesson: never trust the word of a man who is not free. Governments, institutions, they aren't always free to keep promises because of politics, hidden agendas, conflicting interests.
So institutional promises are fragile. But then, Meyer Lansky, the mobster, his word was apparently solid.
It's an incredible contrast. Lansky's handshake was supposedly worth more than the strongest contract. He was the mafia's banker, keeping track of vast sums apparently just based on his honor, his word. Why? Because in his world, breaking your word had immediate, severe personal consequences. Reputation was everything, and trust was essential currency.
So personal accountability, direct consequences made his word reliable.
Far more reliable, paradoxically, than many institutional guarantees. The source makes the same point about old-school pit traders on financial exchanges.
The guy shouting in the trading pits.
Yeah. They were self-employed. Their word was their bond. A handshake deal was absolutely binding because their personal reputation and livelihood depended on it. The author notes he never saw one break their word in decades. But dealing with representatives of institutions, less reliable because the individual wasn't personally on the hook. They represented the institution's interests, not necessarily their own honor.
So the final takeaway really is this stark difference between institutions and individuals when it comes to honor and trust.
That's the critical insight, yeah. Institutions, large corporations, governments, structurally, they might struggle with genuine honor because of agency problems and conflicting incentives. But individuals can, and often do, possess honor, especially when they have real skin or even soul in the game. Knowing that difference is key to navigating the world.
Okay, wow. That was a seriously deep dive into Taleb's Antifragile. We've covered a lot. Why payoffs matter more than being right. Mother Nature's focus on survival over opinions. The absolute necessity of skin and soul in the game. The potential pitfalls and deceptions of modern corporations. And finally, where true honor might actually reside.
Absolutely. And hopefully understanding these ideas gives you, our listener, some powerful tools. Tools to cut through the noise, to make better decisions by focusing on consequences, not just words, and to really evaluate the systems and people you interact with. Who really bears the risk? Whose incentives are aligned with yours?
It's about looking past the surface narrative. So as we wrap up, here's that final thought we like to leave you with. Considering everything we've talked about, skin in the game, soul in the game, the difference between talkers and doers, think about this. What's one area, just one, in your own life, personal or professional, where maybe, just maybe, you could benefit from deliberately putting a bit more skin in the game?
And alongside that, how can you use this framework looking for that costly commitment, that genuine stake, to get better at figuring out whose words you should really trust and whose you should probably discount, who's just talking and who's truly walking the walk?
Something to chew on. Think about it. Thanks for joining us, and we'll catch you next time on The Deep Dive.